Hello and welcome to the Week in Markets. I'm Paul Durrance, Investment Director, and I'm delighted to be joined by Portfolio Manager Matt Henderson. Now, it's been a busy week for markets. I suppose if we think about where we started the week on Monday, we got off to a good start, given that there were no further escalations in the tensions in the Middle East. And so we saw a bit of relief in equity markets, but there's been a lot to digest. We've had corporate earnings, we've had economic data globally, and we've finished the week with US inflation. I suppose, Matt, if we start with the corporate earnings picture, we focus on that because of where share prices typically follow corporate earnings, and we look for whether companies are beating earnings expectations or revenue expectations, but also what management teams are saying. I suppose, so what stood out for you this week?
Yeah, so as you mentioned, Paul, midway through US earnings season, so we've had about 220 out of the 500 companies report to just provide a bit of perspective. And now we're starting to see some of the bigger names within the index report, so some of the bigger tech names. So we thought we'd do a little bit of a compare contrast and just sort of highlight how valuations can ultimately play a part in terms of how equities react to these reports. So something like Meta or Facebook, and we're going to compare that to Tesla. So the context is that this year, previous to the report, Meta had been up 45% and Tesla had fallen 45%. So their earnings report, Meta to begin with, that shows that its revenues and its profits are better than what the market had been expecting. However, some of the forward guidance that it provided, the markets didn't see favourably when it was talking about spending more on CapEx. So markets didn't like that. So share price actually fell, negative reaction. If we look at Tesla, however, that actually reported weaker revenues and weaker profits than what the market had originally thought. But its forward guidance was more positive when it was talking about the release of its cheaper vehicle. So despite the weaker revenues and profits, forward guidance was enough to push up stock price afterwards.
And I think it just shows you the importance of valuations. You know, when companies are at record highs, expensive valuations, the ability to surpass market expectations is that much harder. Whereas you've got a company like Tesla, share price has been down, and so expectations are low, easier to beat.
Yep.
I suppose the other two major tech companies reporting were Alphabet and Microsoft. A similar trend in terms of the beats.
Yeah, so both companies provided beats, both the revenue and the profit side, and the report showed that both companies were benefiting from AI themes, VR themes, cloud computing, cloud data coverage and services. So that theme in corporate America continues to accelerate and continue with AI. So markets reacted positively to those, rewarded the share price.
Excellent. So a clear message from market that as the corporate profit cycle accelerates, along with the economic growth cycle, those businesses that are being more vigilant on their spending plans and focusing more on profit margins are being rewarded by their share prices. So if we move now to the economic picture, we've had economic data globally with the business services data, which is more of a timely indicator of how corporates are performing. If we focus here in the UK, what were the results?
Yeah, so this survey data breaks the economy into its two main components, being manufacturing and services. And we've spoken in these videos about the momentum or trend that we've been seeing in global manufacturing data, seeing that pick up. Well, this is the first data point we've had where we're seeing a slowdown or a hiccup in that data. So actually saw the manufacturing side take a step back. So seeing weaker manufacturing part of the economy in the UK. However, what we're continuing to see is that robust nature that we're seeing within services. So actually saw those PMIs move higher. So still within that 50 zone, which signals that we're seeing that part expand of the economy.
And I think it's important, you know, looking ahead to the next Bank of England meeting on the 9th of May, you've got economic growth improving in the UK, surprising the Bank of England forecasts, services being really healthy, and the prices inflation still remains quite high relative to history and long-term trends. So it does put the Bank of England in a predicament of what they do on interest rates, and some of the comments this week have been a bit more cautious on cutting interest rates in the near future. Excellent. So if we look at the UK, we've looked at the UK and we turn to Europe. Is it a similar picture in terms of the growth story there?
Yeah, seeing a very much similar picture to the UK, where the manufacturing side of the economy was starting to see that first step back or first pullback in recent data, whereas services continues to be the robust side of the economy.
Excellent. So let's turn to the US, the largest economy in the world. We've had the GDP print on Thursday. Last year, economic growth was far stronger than most investors anticipated. Start of the 2023, most actually expected a recession given where interest rates had got to. That has certainly not been the case. This year, how has growth started?
Yeah, so to begin with, what we would say is that we're seeing positive growth. So the number is positive at 1.6%. So quite a bit lower than what the previous quarter print was. It was actually slightly lower than what markets had been expected. But if we actually look through the data and look at the numbers, there are bright spots to look at. We're seeing positive consumer numbers, domestic consumption numbers from the US. And we're also seeing things like higher import numbers, which in the GDP calculation actually becomes a drag. But if we actually think about it logically, higher imports is a signal of stronger domestic demand in the US.
Excellent. Let's finish off with the US inflation report. We had that out today in the afternoon. There has been some challenges with the inflation, surprising repeatedly to the upside this year, which has meant that investors have had to recalibrate their interest rate expectations in terms of cuts. They've pared them back. What did we find out in the inflation report this afternoon?
Yeah, so PCE, which is the Fed's preferred measure of inflation, was out. It was at 2.7%, so slightly higher than last time's reading, about in line with what markets had been expecting. And if we look at that on a month-on-month basis, that actually works out at a 0.3 print. But when we're looking at them shorter-term numbers and starting to annualise them out, we're actually starting to see the rate of inflation within the US just start to pick up slightly, which, similar to the problem that you spoke about with the Bank of England, we're seeing those similar dynamics play out in the US.
Excellent. So we've got the Federal Reserve meeting on the 1st of May, next Wednesday. So it'll be interesting to see the communication they give around the stronger inflation impulse, growth slowing but still strong, and the labour market still firm. So we'll keep you up to date with that. Thank you for watching, and we'll see you next week.